Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters on this last trading day of the week that saw record-making highs. Investors, they're gearing up for a magnificent 7 earnings and keeping a watchful eye, of course, on what's to come between the U.S. and China and those trade talks. There's just an hour to go until the closing bell, and right now the popular averages, they're showing green. We've got the Dow up about 200 points, the S&P 500 up about 0.5%, your tech-heavy NASDAQ up about 0.4%. Let's welcome in here Lou Bassonez, Executive Vice President of Market Strategy at Prairie Operating Company, and of course he is the founder of thebigskinny.com. Our Washington correspondent Ben Werschkul, and markets and data editor, that would be Jared Blickery. They are all joining us throughout the show to break down the headlines. Let's check in on with Jared first to get the latest on the day's action so far. Jared.
Yes, we're looking at some decent gains here, especially in this low volatility melt-up that we call a bull market. Here's the Dow. It's up 200 points for the day, almost 0.5%. Let's check in on the 5-day totals. By the way, we'll start with the 1-day. Dipped into the red early after the open, but up and away from there. And here is the 5-day total. You can see it's up about 1.25%. The NASDAQ up just a little bit less than that, and the S&P 500 leading the show up 1.5%. We'll also take a look at the Russell 2000, which is up about 0.33% today, not quite up to 1% for the week, not leading today. And let's take a look at the Treasury notes as well. Here's the 10-year down 2 basis points to 4.39%, the 30-year down to 4.93%, and the U.S. dollar index. This is interesting. This is what I've been watching overnight. Ever since Jerome Powell and President Trump got together yesterday afternoon, and it looked like Trump was not quite as mad at Powell as everybody thought he was, and he's going to keep maybe Powell in for the rest of his term, the dollar has drifted higher. And we've seen this play out against commodities and also crypto, and I'll show you those in a minute. But first, we have to get to the sector action for the day. Materials, XLB, that is in the pole position, up 1%, followed by consumer discretionary, industrials, financials, all of those outperforming the S&P 500. To the downside, communication services, we'll take a look at that. That's down 1%. And then we have some smaller losses for real estate, energy, staples, and utilities. And here's the NASDAQ 100. And here we can see what might be behind some of these losses that we were talking about in the communication services sector, some telecom things that we're going to get to, Charter, Comcast down, and also a few others. But here's Amazon, one of the few of the Mag 7 in the red here. Tesla's up 3.35%. That's giving a boost to the ARK Innovation Fund. Microsoft up 1.2%. And we also have some other outliers here. Want to get to the Dow, and then we'll hit some futures in crypto real quickly. Besides the mega caps, we see American Express up 1%, so is United Health, bouncing back from another big loss yesterday. Nike up 1%, so is 3M, and Goldman Sachs. That's got to be near a record, or maybe close to one, if not a record. And here the futures action, a lot of red on the board. I think this has to do with the dollar strength that we're seeing. So I'm just going to give you this picture worth 1,000 words right here, and we're going to switch over to crypto, where we see Bitcoin down 2.25%, Ripple down 5%, Solana down 3.25%. And I'll show you the last 2 days of price action so we can see. Here we go. We saw most of the meltdown came overnight, but it started right around here. That was about the time that President Trump and Jerome Powell of the Federal Reserve were getting together. So it's hard to say that it was a direct cause for that because I didn't see the price action at the time, but definitely saw the meltdown in the hours after. That was when we were sleeping. Anyway, back to you guys.
Lou, I also want your take, get you in here. What do you make of today's trade with Trump and trade and tariffs dominating the headlines, Lou?
Yeah, I think Jared hit the key phrase. It's a low volatility melt-up, right? We had expected results from Tesla that were weaker. Google surprises everyone. But at the end of the day, it's deja vu all over again. We're going into the weekend. There's some trade deals that are in the headlines that might get done. They might not get done. And I think you see the major indexes here trying to break out to new highs, but aren't going to do that yet because no one wants to be too long and overexposed over the weekend. So I think what's interesting to me is that almost 1% rise for the small caps, Russell 2000. That is an index that has been unloved and underweighted and undervalued for a little bit too long, in my opinion. So could be the sign of good times to come there.
And Lou mentioned there, top story, one of them being Trump and trade. So let's stick with that and bring in Ben Werschkul now. Ben, President Trump is in deal mode, Ben, it would seem, for talks with China next week. What do we need to know?
Yeah, so as Lou mentioned, we're looking ahead to some of the trade negotiations. We actually have two big high-profile talks in the offing in the coming days. The first up is actually on Sunday. What we learned this afternoon is that Trump is going to take advantage of a trip to Scotland this weekend to also meet with the European Union. The European Commission president is going to visit him on Sunday for talks, for the latest round of talks there. These are, of course, with the entire bloc, which is America's largest trading partner. And what we've seen is the kind of negotiators, report after report after report of them being close to a deal that currently is about at a 15% rate with some exceptions, but they've been at the proverbial 5-yard line for weeks now, literally. And then the question being whether this can be another round to push them over the line ahead of this August 1st deadline. And then, as you mentioned, right on the follow on that is on Monday is China. The Treasury Secretary Scott Bessent will lead a team to Sweden to meet with China, to meet with Chinese negotiators. And the main agenda item there is to implement another 90-day pause on tariffs. We would have a tariff snapback on August 12th if there's no action there. So the markets are clearly watching that the most closely to make sure that a tariff pause continues as the negotiators try to set the stage for a meeting between President Trump and President Xi, presumably by this fall. There's a whole lot of other issues on the table with China. One I want to flag, because Jared mentioned it, was currency. Trump had some really kind of sharp comments on the dollar and the Chinese currency today. So that could be a flashpoint to watch on Monday and Tuesday when they sit down.
You know, Ben, you're mentioning the trade talks there with China, with the EU. I'm also interested to hear more about Japan, Ben, and just what do we know about how those talks are progressing, Ben, and how the two sides, how the U.S. and Japan are thinking through that deal?
Yeah, so if you think of Europe and China as two steps forward, this Japan deal in the last couple hours has kind of taken a step back a little bit. This was one of the biggest developments of this week, a pact with Japan that would lower tariffs to 15% on a range of goods as well as autos. But what we have is really dissonant messages from the White House side and from the Japanese side about exactly what was agreed to. There's no full text of a deal here. The big issue here is this $550 billion investment vehicle that Trump has touted as the centerpiece of the deal in a lot of ways for his view. He's described it as a signing bonus for the U.S. Other aides have described it as a sovereign wealth fund, essentially a huge influx of money. The Japanese really are describing it as something very different. They describe it as more of a handshake agreement to find areas of mutually beneficial investment for U.S. and Japanese companies. So there's a real disagreement there, and it could sort of complicate this deal. But it's also important because this provision is clearly a favorite of Trump, and he's looking to include it in a lot of others. He had some comments earlier today that suggested he might be looking to include it with Europe as well. So we'll see on that front exactly what was agreed to and whether he includes it with others as well. All
right, Lou. So that's one impressive signing bonus. Get your take, Lou. Trade and tariffs, how are you thinking through these dynamics, Lou, as an investor?
Yeah, I cautiously say this for next week. I really think everyone's grown numb to the on again, off again trade deals. And next week, I don't think it's going to really make a difference because we have so many big tech companies reporting earnings. I think that's going to come center stage. Everyone's going to focus on, does the strength from Google read through to Amazon, to Microsoft, and move from there. So I think you got a little bit of a reprieve from the trade wars tugging the markets up and down for a week, maybe.
All right, joining us now to talk more about this is Michael Guyad, portfolio manager at Tidal Financial Group. That firm has more than $40 billion in assets under management. Michael, welcome to the show. Great to see you, especially on set.
I appreciate that. It's a little bit outdated. A part of tactical rotation management. My own RIA was part of Tidal, but Tidal's the advisor to my free markets ETF, so still related.
Appreciate the update. Let me get your take, Michael, on that same theme we're talking about, trade and tariffs.
Yep.
As Ben was mentioning here, so Trump saying odds of a deal with Europe 50-50. Says U.S. and China have the confines of a deal. What do you make of those headlines, Michael? And what do you make of the market reaction response to them?
It's reassuring that policy is basically a coin flip, I think is sort of the way to say it at this point. Look, I think you said it correctly, Lou. The reality is the market doesn't really seem to care about any of this stuff anymore. There's been whipsaw after whipsaw on the wording, on the rhetoric, on what's going to happen next. The market's just going to do what it wants to do based on liquidity. I think beyond the tariff dynamics, the market is forward-looking and is seeing deregulation as a very big tailwind for the entire economy, for the broader stock market, certain stocks, certain sectors. So I don't know if any of this really matters, other than it's just great noise to somewhat pay attention to.
Can I ask you, Michael, do you think that Trump believes in tariffs as a policy, and he's been banging on tariffs for a long time, and you're going to see tariffs get imposed. But he also believes in his legacy, and he doesn't want to wreck the economy, the stock market. Do you think maybe what the market is trying to tell us, and tell me if I'm reading too much into it, but do you think maybe that the signal the market is sending is that he is actually seeming to thread that needle right now?
Maybe. I'm not as convinced that whoever is president, whether it's Trump or somebody else, really affects the market that much. I mean, ultimately, it's still going to be liquidity driven. Now, again, I go back to the one thing I do think that does matter from a condition perspective is you remove regulation, you remove red tape. That's going to be very beneficial towards growth. That is also disinflationary, which may be why Powell does ultimately lower rates. It's actually because of Trump, but not because Trump is telling him to do so. It's because deregulation forces more competition, creates more efficiency, and that inherently brings prices lower. Right, but again, I don't think tariffs really matter whatsoever. We just went through this unbelievable collapse and then V right back. Tell me, tariffs matter.
Well, did we make the bounce back because people assumed, hey, it was Liberation Day and we had a freak out, and now people said, well, hold on, now he's backed off his maximus position, and that explains the V.
Yeah, partially, but the market was also very oversold, and I think there was a point where even in the midst of the heavy part of that decline with the tariff scare, credit spreads never really widened, so the bond market never really believed that it was going to cause some real slowdown risk to the economy. And then the market just basically rebounded on partially Trump pausing the tariffs, which he floated the idea 2 days earlier, testing the market's reaction. And then the reality that default risk is still fairly low across the economy.
So where do you stand now? Now we had the V, Michael. Where do you stand on this rally?
So I think the complacency is through the roof. I think you look at call option volume, you can clearly see that. When you look seasonality, you're pretty much at the point in the calendar where historically the VIX bottoms. And you tend to see volatility pick up into September. So it's interesting to see that we're in this sort of low volatility, in quotes, melt up. But small caps, yeah, they're up 1%, but they're not at the prior highs, and things are still, I think, from divergence perspective, worth noting. There are going to be selective winners, but I do think you're probably in for a risk-on, risk-off type of sequence. Maybe I'm biased in saying that because I have 3 funds that try to play off of that, but the seasonality does seem to favor that. That's a short-term dynamic. The free markets ETF, which is focused on deregulatory plays, that's a longer-term dynamic, and I think that's a much underappreciated aspect of what's to come.
So would you be looking for, in the near term, Michael, would you be looking for a pullback?
Most likely, yeah.
And do you think investors step in and buy that pullback?
That's been the Pavlovian response. Right? It's like, buy the dip, buy the dip. It is remarkable to me how, with conviction, retail comes in. And when I say conviction, I'm talking about levered ETFs, call option volume buying that you see, activity that you're seeing. So there is, everyone is trained to do the same thing. Now, at some point, that's going to fail. Right? It's like at some point the dip becomes not a dip, but something much more systemic. I don't know when that is. I've been wrong in trying to think the next one would be the one, right? But regardless, look, we know markets tend to go up over time. Right? It's just about what time frame you want to play.
What do you think, Lou? Possible pullback, and if we did, they'd step right back in?
Yeah, I think the buy the dip is trend-worthy right now. You're seeing it. Institutions seem to be kind of trying to whipsaw in and out and predict it and be too cute. Retail looks to be much more powerful. I don't know if that's a sign of a paradigm shift. I mean, retail some days is up to 35% of volume. If that continues, they have much more sway. But I think to your point here, there's a gravitational pull up and to the right now, especially because of earnings. Yeah, Mag 7's leading the way with about 14% expected earnings growth this quarter. But as you get into the back half of the year, it's supposed to level out to about 11% for Mag 7 and the unmagnificent 493. So you see that happen, I think it gives you reason to push these markets higher. But I would expect some volatility. I do think you have to have a value bias right now. What are the names that haven't risen as fast, that haven't had multiple expansion, that could play catch up in this market that might trade sideways or down a little?
And Mike, let me just get your thoughts. Lou mentioned the Mag 7 there, big tech earnings next week. Yep. What are you watching for there, Michael? How important are those reports for the market?
I am not watching tech whatsoever. No, and I say it because everyone else is. I mean, and that's my point, because everyone else is watching it. There's no alpha in trying to identify or figure out what is going to happen next on the tech side. There are a number, to your point about a number of these other companies that are announcing earnings. Comfort Systems, which is the ticker's FIX, that's in our free markets ETF, FMKT, which is focused on deregulation. Blowout earnings, up 20% for the day. That has been a beneficiary as a company of deregulation because it's an office HVAC company. Trump effectively gutted the EPA. Well, that's a form of deregulation. You're seeing certain interesting, sort of more speculative plays like Archer Aviation, Joby. Not necessarily on earnings, but probably on earnings, or they're going to guide higher. Why? Because of some of these executive orders that explicitly target those business models, and again, is focused on deregulation. So I don't think there's any real value in looking at the tech earnings here. I think looking at earnings from companies that are benefiting from these executive orders, that's where it's going to get to be really interesting.
Michael, great to see you, especially on set. Co-portfolio manager of the Free Markets ETF. Got it right. Thank you, sir. Appreciate it. And we are just getting started here on Market Domination. Coming up, Chevron regains the right to pump oil from Venezuela, but what does it mean for the delicate ecosystem of oil prices? We'll take a deeper dive into that. Plus, tariff disputes are disrupting commerce. A new report indicates the number of shipping containers carrying U.S. imports fell for a second straight month. We're talking to the author about what that means for the economy and consumers. And Palantir may truly be one of a kind. We'll tell you why that stock is being seen in a new light as an all-star here. That story and more coming up. Stick with us. U.S. reportedly making a shift from its strategy on Venezuela's oil sector, starting with Chevron. And Yahoo Finance's Inez Ferre joins us now with more. Inez.
Yeah, Josh, and this is quite a reversal from what the Trump administration had as a strategy back in May when it revoked the right for Chevron to pump oil in Venezuela. It is now reversing that, and now Chevron will be able to pump oil in Venezuela. Analysts are saying that this is a positive for the company. This is a positive catalyst, even though the stock hasn't reacted much today. Year to date, the stock is up about 7%. But what analysts saying that this creates additional cash flow for the company. Chevron had been pumping about more than 200,000 barrels per day out of Venezuela before that initial permit was revoked back in May. And this, of course, also comes on the heels of that arbitration ruling last Friday, I believe, that lets gives Chevron the stake, the Guyana stake, from the Hess acquisition. So overall, a positive couple of weeks for Chevron. But this announcement from the Trump administration is really kind of highlighting the delicate balance that the Trump administration is doing with these sanctioned countries like Venezuela, and the need to keep energy prices low, because this reversal comes on the heels of a deal between Caracas and Washington. Some American that have been detained in Venezuela, they will be brought back to the U.S., and Venezuela has agreed to that. And then also some Venezuelans, more than 200 Venezuelans in El Salvador, will be taken back to Venezuela. So again, this kind of balancing act between keeping energy prices low, but also putting pressure on sanctioned countries like Venezuela, a similar situation with a country like Iran, and also with Trump wanting the war to end in Ukraine, and the type of pressure that is put on Russia as well.
Bigger picture, Inez, looking at oil prices, are we still looking for lower prices by the end of the year, Inez?
Look, we are looking at lower prices by the end of the year. I'm going to just pull up the chart just to show you where we're at right now. Part of what analysts are talking about is some volatility that we could be seeing going into September. This is because those OPEC plus increases that OPEC has announced, those will be absorbed in the market by then. Trump's 50-day ultimatum for Russia to end the war with Ukraine, that expires at the beginning of September. And then you also have EU price caps on Russian oil that is set to go into effect at the beginning of September as well. So you may see some volatility in September, but the thesis overall hasn't really changed with respect to supply in the market, that you will be seeing an increase of supply in the market. Of course, part of this has to do with those OPEC plus barrels that are coming into the market.
All right. Thank you, Inez. Appreciate it.
Thank you.
Well, crypto has been having a big moment, we know, with Bitcoin reaching record highs. And Steve Kers, Galaxy Digital Global Head of Asset Management, joined my colleagues Friday to discuss how long crypto's highs can last.
So obviously, Strategy is the sort of best known company that has done this, and has also, by a pretty wide margin, the largest amount of Bitcoin on its balance sheet. Is this just a situation where the trend is following price? You know, all these companies are interested in doing this as they see prices going up more?
That would be the cynical take. I don't think so. I think that this is about 2025 being the year of public markets and crypto colliding. And I think that is partly these treasury companies. It's partly companies like Galaxy and Circle going public in the US. But when you step back and look at how much money has been deployed, which is less than $20 billion into these treasury holding companies, it's actually a drop in the bucket in terms of the US public markets. And so while there may end up being some of these that don't make sense or certain ideas that aren't going to work out, I really think that this is the beginning of a much bigger narrative that includes other public company ideas that we haven't even seen yet.
A few years ago, this kind of breadth of companies doing this would be unthinkable, right? Bitcoin is still, and other crypto, it's still a very, well, maybe you guys thought of it, but most companies, most traditional establishment companies, this is still not something they're going to consider. And part of the reason why is because cryptocurrency is very volatile. And so it can be more difficult to manage one's balance sheet with a very volatile asset on it. So when you guys are counseling these companies, what do you tell them about how to manage that?
Sure. Well, one size doesn't fit all, obviously. And yes, you're right. In some ways, we built Galaxy exactly for this moment, this intersection of traditional finance and crypto finance. And it's true that there is volatility in crypto. I think there's a really different story for putting Bitcoin on your balance sheet if you have a perspective on monetary policy, the deficit, which you've talked about already this morning in the program, than if you are really focusing on one part of an ecosystem. So one of the most interesting parts of the last month has been that we haven't really seen an ETH-driven crypto rally in some time. So ETH is up over 50% in 30 days, and that's largely driven by the narrative of ETH coming to Wall Street through these treasury companies. That's a very different narrative than the Bitcoin as digital gold or a hedge against the system narrative. That's how is the on-chain economy growing? What is Ethereum doing as a part of that? And so our job when we're counseling companies around Ethereum, for instance, is not only helping them access Ethereum properly, but also how do we optimize and generate yield within the treasury, which could include option strategies. It could include DeFi-driven yield. It could just include staking, which actually secures the Ethereum network and offers yield above what, for instance, an ETH ETF would offer.
Do you think that Ethereum at some point is going to be the more dominant asset on company balance sheets for some of these reasons?
Well, I'm not sure about that because Bitcoin is such a developed story and has really a place in the macro asset lexicon. But I do think that the ETH narrative starts to unlock the crypto narrative. And I think for a very long time, one of the reasons crypto has been volatile is that adoption has been limited to the crypto sandbox. And this public markets construct is allowing crypto to break out of the sandbox. When we talk about an ETF for Solana or other assets, you're still limiting what Solana or Ethereum or Sui or many other ecosystems were meant to do in crypto. And so having the ability to create a company that isn't so narrowly defined by an ETF rule, but can actually allow for that ecosystem to grow and develop and invest, that's the dream of phase 2 for a lot of these crypto companies.
Steve, most of the companies that have added this on their balance sheet are sort of fintech or crypto adjacent, right? Is there a point in this cycle where we see companies that don't have anything to do with it that are adding it?
I think so. Yeah, and I think you're seeing that shift. So it started with Bitcoin, and of course, it's moving to other coins. You've also seen someone like Reserve One come out with a very novel, diversified group of coins. But when you put it all together, we're well over 200 companies globally that have crypto on their balance sheet. That's not just public companies, it's also private companies. We're talking to really normal looking real estate businesses, for instance, as one example that is very different than just a company trying to take a shell and put one asset in it.
Steve, thanks a lot for your time this morning. Appreciate it.
Thanks so much for having me.
Stay with us. When we return, we're talking top tickers. You'll want to know what's making moves and why. That's coming up and much more. Piper Sandler initiating coverage on Palantir with an overweight rating. That firm noting the stock as a high-risk investment, but highlighting the company as an AI secular winner. Here to break it down for us is Piper Sandler, co-head of technology research. That would be Brent Bracelin. Brent, it is always great to see you. So let's get right into this, Brent. You initiate Palantir with an overweight. You're a believer, Brent, a new platform powering the AI revolution, you say. Just Walk us through why this is a Brent buy. How do you explain it to your clients?
Yeah, most expensive stock on our coverage list at 52-week highs. Why are we overweight? Why do we like this business? And I think it's important to note that, one, our price targets are kind of 1 year out, and two, we've seen the stock that's acted very volatile, right? 20% to 29% drawdowns over the last 5 years. You've had the stock down 12% the day after earnings in Q1, but we don't really think that's all that important. What really matters is how big this company can get. And that's where we spend a lot of our due diligence and a lot of our time trying to understand what is Palantir, what do they do, why it's so special. And in the end, we really think this is a secular AI winner. We're going to put it in the same camp as private AI secular winners like an Anthropic or an OpenAI for a different reason. And what they do that's special is they really have created a platform that's going to help people build new AI applications. And the popularity of that is what was shocking to me. We did some due diligence in June. We went to a Databricks conference. We went to a SAP Sapphire conference. We're talking standing room only for large enterprise customers that want to do more, learn more, engage with Palantir. If you look at Palantir, say 5 years ago, they were competing in some cases with the likes of Databricks. They were competing in some cases with the likes of Accenture and Deloitte. These companies now have turned from competitors to partners. And so I really think that there's a sea change relative to the opportunity around Palantir. Does that mean the stock is going to go straight up from here? Probably not. There's going to be volatility. There's going to be lots of opportunities to get involved here. But we do think this is going to be one of the key app platforms. It's addressing $2 trillion separate, distinct markets, common platform, common shared R&D, but two really big secular opportunities in defense and enterprise.
The pushback, as you well know, Brent, I want to get your thoughts on this, has been on valuation. I talked to Brent Till over at Jefferies, and you know Brent, smart guy like yourself. And I remember Brent telling me, listen, he likes the company and he likes the technology, and listen, the fundamentals, he says, look solid. But I think he actually referred to it as an irrational valuation. It's just too pricey, he said, which is why he has the equivalent of a sell on it. How do you respond to that, Brent?
Listen, there's no doubt this is a very, very richly valued company. It's the most highly valued company in this space. And so what you have to underwrite is the long term. And the long term isn't a straight line up. There's variances, and that's what we're kind of betting on, is you're going to get a chance to buy this stock lower, but it should be a stock that you can buy. This is a company now that is top 25 weighting in the S&P 500. So one way to cheat is you can buy the index and take a small ownership stake in Palantir without taking that valuation risk, right? Company-specific risk. So if you own the index, the S&P 500 index, you own a little bit of Palantir. Our view is the next year, there will be opportunities, there'll be buying opportunities, be patient. But this has the potential, we think, to be a AI secular winner, to be one of the key platforms. We're talking about a sector looking at cloud software where there are zero 30% public growers next year. We think Palantir can be in a universe of one. So yes, we're treating this a little differently. We're looking kind of at the lens of what could this be worth? What's the art of the possible? If you're not comfortable with looking out 5 or 10 years, it's going to be really hard to justify valuation on this one.
Brent, who would you consider the competition here? Who would you consider Palantir's rivals?
So if you look at what's driving this business, there's two secular trends, and these are the competitors. On one hand, you have defense, and for the last 30, 40 plus years, the defense industry has largely spent about $1 trillion globally, largely spent money on big machines, proprietary software. We're seeing a secular shift away from spending on big machines, big tanks, to small drones and AI software. that we're still very early. We think this government business today, $2 billion, just in looking at a few years, 2030, we think it's going to 5x to 10 billion. And that's just the beginning. This is a 2-decade cycle where we're going to shift spending, $1 trillion worth of defense spending in a completely different area. Palantir's leading that charge there. That's the first secular trend. Second secular trend is on enterprise. As we think about competitors in the enterprise, we've had a 30-year pendulum swing towards buying prepackaged software. Historically, 30 years ago, 40 years ago, people built their own software, a lot of custom software. Today, custom software is about 24% of the $1 trillion enterprise software market. We think there's a pendulum swing back, especially with AI tools, towards custom builds. So in some cases, the competition for Palantir is prepackaged software. If I'm a large enterprise, I can go out and buy prepackaged software from the likes of the traditional application vendors, or I can build it myself using some AI tools, using my own data. And that's kind of the competition. Pendulum swinging back to custom, they're going to be one of those platforms that enables large companies like Citi, large companies like Wendy's to build their own apps.
Final question, Brett. You know, I talk to CEO Alex Karp every quarter. We always check in, talk earnings. He's a different kind of guy. I'm curious, you've covered companies for a long time. When you think about Palantir's leadership, its culture, does it dovetail with other companies you cover, Brent? Is it different? How would you characterize it?
Unconventional. The whole journey with this business is unconventional. The idea that this was a defense tech startup in its origins and sued the U.S. Army, that's nothing I would recommend doing to try to building a healthy business, right? But they sued and won. They didn't sue and won because they thought they were treated unfairly. They sued to change the process of how the government selects not just Palantir software, but anyone's software. The best software, the best technology should be selected, not by the historical way it was being selected. That same process, the idea that the government, $1 trillion defense spend globally, should buy the best tech, is now also going to be a process change, procurement change across all government agencies. And that happened with the presidential executive order that was signed in April. So we're at the beginning of a whole change in the process of what type of technologies government's going to buy. And I think that's underappreciated. But yes, very unconventional management team, unconventional journey, how they got here. I think it will remain probably unconventional going forward.
I think Dr. Karp would appreciate the unconventional characterization. I think so. Brent, we are always lucky to have you on the show. Thank you, sir.
Great to have me. Thank you.
Now time for some of today's top trending tickers. We're going to start off here with Procter & Gamble. It was hit with a downgrade at JP Morgan. That move comes ahead of the company's fourth quarter earnings report. That's on tap next week. Lou, so team at JP Morgan, basically what they're saying is big picture, we expect another challenging quarter for most of the names, the 16 names they say they cover in that household and personal care industry. They do downgrade Procter & Gamble to neutral, says that we're taking a pause. We expect another lackluster quarter and normalization of category growth. They say, Lou, this one, they say, listen, best in class. They talk about robust and disciplined innovation process. They say that's second to none. But what they seem to have is some concerns around lower income consumers.
Yeah, I mean, best in class in a boring industry is hard to get excited about, right? I mean, but this is a defensive play. I mean, if you look at it right now, look at the performance over the last 3, 6 months, year to date, 1 year.
Year to date in the red, down about 5%.
Yeah. I mean, it's been solid over time, 3 to 4%, but when you can go get 3 to 4% plus in treasuries, why allocate here with equity risk? So I think it makes sense. I mean, a lot of times analysts are after the fact, after the earnings report. I think it makes sense ahead of time, saying, hey, consumers going to be strained. We know that's happening, especially on the lower income brackets.
Get more cautious.
Yeah, it gets more cautious, and it's safe to kind of step to the sidelines here. There's other opportunities.
All right, let's talk about another one here. Carvana riding higher as Oppenheimer upgrades that one to outperform, knowing the company's business model is now humming, and that's how they put it. They say upgrade this one to outperform, so equivalent of a buy. Business model, they tell their clients, it's humming, generating meaningful cash, scaling, capitalizing, they talk about on well upon improving underlying demand trends. They do acknowledge, yes, this one's had a move, Lou.
Yeah.
We're up about 60% this year, but investors still underappreciate, they argue, near and longer term growth and profit potential.
Yeah, I have to be careful here. My reflex is to say, why are you so late to this party? But to Brent's point at Palantir, he's a little late to that party too, but there's all the tailwinds necessary to keep growing. People were late to NVIDIA, and look how far NVIDIA's gone. So I think Carvana here, it makes a lot of sense to me from this standpoint. Tariffs are directly impacting autos, new auto sales. Carvana is more of the frictionless auto purchasing platform. I think it makes sense. It's consumers are going to go, hey, I don't want to pay higher prices for a new auto. I can do something that's easy and not have to deal with that whole used car sales process, which we all abhor. So it could lead to it. So it could be a strong gainer here on the tariff headwind.
All right, third one I want your take on, Lou. That would be Boston Beer. Now, they're topping earnings estimates for the second quarter. Company also revising lower its expected financial hit to earnings. So they report earnings per share for the second quarter. That did beat. They did revise lower the expected impact EPS from tariffs. The analysts are weighing in here. We've got Jefferies, for example. They have a hold on this name. They talk about better margin visibility. They talk about more benign tariff headwinds. The company is saying weaker volume environment, Lou, but they also talk about raising gross margin guidance as we continue, they say, to see positive impacts from multi-year margin enhancement initiatives. The stock it's had a rough run. It is down about 30% this year.
Yeah, I think this is a relief rally, right? The tariff impact is not going to be the 20 to 30 million. It's maybe 15. You're seeing some margin expansion. This one's nostalgic to me. I mean, this was like the first microbrew that was out there before the world blew up with it 47,000 options. They have the Truly brand, so I think they have good consumer demand. But I think also, too, what concerns me is they're pointing to immigration issues and the decline in the Hispanic market. I think, from a company that really has got to be led by marketing when you talk about this alcohol and beverage segment, you can overcome those 1% and 2% demographic shifts. I don't think you need to lean into that. Sounds of me a little bit of an excuse. But again, you said it's been going rough this year performance-wise. This is a step in the right direction if they can follow through.
All right, we'll leave it there. Meanwhile, we're building up ways to play the housing sector as well. More market domination. That's right on the other side. We're taking a look at the names in the home builder space. Companies including D.R. Horton and Pulte Group reporting earnings on Tuesday, surprising analysts with solid earnings beats. We're navigating how to play the home builder sector with the Yahoo Finance playbook. And joining me now is Jay McCandless, Managing Director of Equity Research at Wedbush Securities. Jay, always good to see you, sir. So we did have a lot of news, a lot of data on that housing sector, Jay. We had earnings, we had new home sales, existing home sales. You, of course, Jay, know the home builder space so well. Maybe start broadly, Jay, high level. You look at the home builders as a sector, which you've covered a long time. Are you cautious, Jay? Are you constructive? How are you thinking about it?
Yep, and thanks for having me on. So I'd say on the builders that get most of their business from move up, these are people who are selling a home to buy a new home. We're still constructive on those names. I would put Pulte in that group, as well as Taylor Morrison, Tri Pointe, and MHO, MI Homes. But we're a little more conservative, cautious on the entry-level sellers with names like D.R. Horton, as well as LGIH and some of the other names there. And I think it all comes down to confidence. Every builder this week talked about how the consumer, especially the low-end consumer, is just not very confident about their financial situation and what's going on with tariffs, et cetera. So until we see some improvement there and or some improvement in mortgage rates, which have basically been stuck at about 7% for over a year now, it's hard to see how things are going to get better on the low end.
Given the uncertainty there, Jay, you're kind of mentioning about the backdrop. Are builders changing at all what they're building, Jay? Are they sort of adjusting in terms of size and price?
Absolutely. So what we've seen is a couple things. The builders have dialed back on their housing starts until the consumer, I think feels a little more engaged, more ready to buy a home. But the other thing the builders have done where they can is bring the square footages down. That's the easiest way to solve for affordability is, take the bonus room off, do something like that, one less bathroom. But I think at some point we need to get some help on rates because I think the builders and especially some of the entry-level names, Horton, Lennar, they've done about all they can do on shrinking the envelope. At this point, it's, again, need some rate help. or need some help on the income side for consumers to get a little more income to be able to afford these homes.
Lou, I want to bring you here as well. Jay talked about rate help. I'm just looking at the 30-year fixed here, Lou. Mortgage News Daily, we're still at 6.81%.
Yeah, I mean, I look at the data here, and Jay, I'm curious your thoughts here. I look at it for existing home sales, and you see those mortgage rates, once they jumped above 5%, we just shifted into reverse and now neutral with those rates pinned up there, even new home sales. So you talked about a kind of a 911 for rate help. How much help do you think 25 basis points lends to the sector? Does it need to be more like 50 to 100 before you really see the impact, and how quickly could it help impact the progress in the sector?
Yeah, sure. So what the builders have told us is they are buying down mortgage rates generally to somewhere in the, call it 5.25 to 5.75 on a 30-year mortgage. So the faster we can get the actual base rate down to that level, that's when it helps. But if we were to go to the low 6s, high 5s, again, I think that could help. But yeah, the 25 basis points we've seen versus last year, it's certainly heading the right way, but would like to see more. I think the other thing that builders have been doing is not only doing rate buy downs to make the homes more affordable, but they're trying to do things like adding some closing cost assistance where people are eligible for it, helping them apply for down payment assistance. There are multiple organizations that provide that now. So the builders doing everything they can without being able to move the rates, of course, beyond doing the buy downs. But yeah, we'd love to see something more like a 5 handle instead of the 6 handle where we are.
Jay, what is investor sentiment around the space and sector right now versus 6 months ago, 12 months ago?
I'd say it's been surprisingly positive. We had a lot of inbounds ahead of earnings season. You saw Horton have a very sharp upward move, I think 17% on Tuesday. People understand that there is a lack of housing in this country. They understand that the demographics and the population tailwinds are still there. It's just the consumer doesn't feel as confident this year as they did last year. So I think investors are kind of being picky and choosy about what they want to own right now. But I think, again, they realize the underlying demand trends are still pretty strong for the group. So it's just when's the right time to get in, right? So we think for the move up names now is a good time. And then when we get to later on in the fall and people start to think about spring 26, then maybe some of these entry level names will look a little more attractive then.
Jay, I'm curious, final question here. Given Trump's immigration policies, Jay, what, if anything, have you heard from the home builders about any kind of material impact to labor?
So I'll add the tariffs onto that as well. The tariff impact has been much less, I think, than the builders expected. Some of the builders had built in a little conservatism into their guidance, and they've rolled that off now. In terms of ICE raids affecting the ability to get homes built, it really hasn't panned out that way. I think if anything, the builders have talked about excess availability of labor, which is helping them get better rates to get the homes built and build them a little more quickly than they could have a year ago and especially 2 years ago.
Jay, always great to have you on the show. Thanks so much for joining us.
Thank you.
Well, the 10 largest U.S. ports are on track for a striking year-to-year change in container volume. According to the McCown report, inbound volume fell nearly 8% in June, marking a second straight month of declines as the impact of tariffs grows. For more on the state of the shipping industry, let's get to Center for Maritime Strategy non-resident senior fellow. That would be John McCown. John, great to see you on set.
Thank you.
So there was this good piece I was reading in Bloomberg, John, and it was citing, I believe, your very data, sir, noting these kind of trends, the number of shipping containers carrying U.S. imports. What are the trends? What are the themes we're seeing, John?
Well, they're in a real downtrend since the beginning of the year. Containers, or kind of the count of containers, are a timely indicator of really economic activity. And in particular, more recently, it's been the tariffs. So containers were down 7.9%, rather consistent downtrend, and this was in June, a consistent downtrend from the beginning of the year. And unfortunately, I think it's going to get worse, as we go forward. And what's unusual about that is container volume has consistently grown at usually well above GDP. Some years it was growing 2 or 3 times GDP. So we're really looking at the first year where we're going to have a year-over-year decline based on my analysis. And we had two times that occurred before, but they were short-lived, right after the financial crisis and during the pandemic. We're now looking at a rather meaningful reduction. And
you don't think, John, it'll be as short-lived?
I don't. But, all of the indications, most particularly with the news on tariffs the last 3 or 4 weeks, they seem to be here to stay in this administration. One way or another, not only the tariffs, but there's something called USTR ship fee program that'll come into place in October. And that's kind of a tax on Chinese operated ships and China built ships. And so that's going to be kind of another form of tariff. Right now, if you look at the value of all the goods coming in over our ports, it's about $2.2 trillion a year. It's about 7.5% of our economy. So a reduction in that volume, first has a commerce effect, an effect on growth. And of course, the volume that continues to come in is going to have a much bigger tax. So it's going to have an inflation effect. I don't know where it's going to kind of land on that spectrum, but it's going to be somewhere that combination of less growth or more inflation. And that's going to be the initial impact. And unfortunately, there really just isn't a comfortable place on that spectrum, in my view.
And as you see this decline in inbound volume, John, that means what for consumers?
Well, for it's really an indication of consumers will be buying less, less imported goods on their retailer shelf. I think the biggest impact for consumers will be the inflation impact, which could be fairly material.
Are these containers, John? Is it how good a gauge of macroeconomic health? Meaning, is there a relationship between volumes and GDP?
Yes, there consistently has been. It's kind of a good leading indicator, I think, of economic activity. In the early years, container shipping grew at multiples, but now we're kind of a little bit above GDP. The investor Warren Buffett famously said that his most favorite economic indicator is rail car loadings. The notion is that, goods are moved before there's commerce related to that. So it's kind of a leading indicator, the Dow theory. I think container volume is really the same thing. Worldwide container volume and is kind of a measure of worldwide growth, and it's continuing to grow, even with the U.S. declining. Not as much, because the U.S. is a big part of that. But I think it's, for consumers, I think right now, I would think the inflation impact is the most impact. Also, I guess with less imported goods, there's less choice. There's less choice in terms of what to buy. Because I spent my career in container shipping, I'm clearly biased. I think tariffs don't make any sense, but I think there's economic underpinning. I think the theory of comparative advantage is a beautiful thing that has, I think the U.S. has benefited immensely by trade. Not only has our economy benefited, but it's more provided more national security. IBM famously had an early saying, world peace through world trade. I really believe that. And so I think as we're moving away from that sort of open trade, it's going to first hurt our economy, in my view. Secondarily, it's concerning in terms of raising tensions.
Trump, trade and tariffs, they dominated today. John, they're going to keep dominating. We appreciate your time. Thanks for joining us today.
Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.